Next, let's look into how trust structures are the most cost-effective solution to manage one's estate. The use of trust in estate planning is often misunderstood as the sole province of the well-heeled in society. On the contrary, trusts are in fact useful tools for even the average families who want to avoid risk or stretch the inheritance over a longer period of time. Is there an affordable way to create a trust? We will be inviting Mr. Leong Mun Kid, Head of Department and Resident Manager of Precepts Trustee Ltd, to share with us his view on this matter. Prior to joining Precepts Trustee Ltd, Mun Kid was a manager in the Legacy Planning Department in Rockwell's Trustee Berhad, Malaysia, taking charge of setting up private trusts for clients. Since 2011, Mun Kid has extensive experience in setting up trusts for families in Malaysia and Singapore. Mr. Leong Mun Kid, please.
Hello, good afternoon, and thank you for taking time to attend this particular talk here. So the topic that I'm sharing today is mainly on standby trust, and the idea about standby trust is that I always advocate it is one of the most flexible and hence the most cost-effective trust solutions that we are offering. So without further ado, just some disclaimer here, all right? So the scope of presentation today would be on, firstly, the quick idea about trust so that you have some ideas who, when I mention certain names, certain parties, who am I referring to? And second would be the principles behind the use of trust. And the third would be the standby trust alone, where I'll be describing some items and attributes of this standby trust and how does it benefit our clients. Right, so you can see here there are some parties here being involved, and you'll be wondering who are they. The first is the settler. So who's the settler? The settler is basically the person who sets up the trust. So if you are setting up the trust, then that's you, right? And then, of course, the formality requires is that you have the settler signing a document that is called the trust deed, and also the settler, you will have to ensure that there are certain documents that you have to sign to transfer the assets, the legal ownership of the assets to the trust. And the question is then to be held by who, right? Transfer to who? Well, to a trustee that you're going to appoint. Now, this trustee here, well, in turn, will be holding it on trust on behalf of your beneficiaries, which may or may not include yourself, depending on how you set it up and what are the objectives that you wish to achieve in setting up this trust. Okay, so now, with that basic idea about trust, and basically if I mention settler, meaning it's yourself, if you're setting up a trust, and the trustee will be the person administering the assets, and of course you're benefiting, let's say, your children, your spouse to be the beneficiaries, right? These are the few terms that I'll be mentioning throughout. So now, other than that, it is very important that you must have some objective, some understanding why do you need the trust from the beginning. Now, these are some of the points that I have observed throughout the years. What are the most common objectives that people are trying to achieve through setting up trust? And what we have here is the principle. The firstly is to preserve your legacy, and the second would be asset protection, and the thirdly would be pooling of resources. So let's move on. On the first point here, now what do I mean by preserving your legacy? Well, the first misconception that a lot of people would have is for a person to set up a trust, you must have a lot of cash, a lot of assets. Okay, it is only available to those who are in the ultra high net worth category, right? But actually that may not be the case, because in a lot of estate and trust that we are administering, this is what we have been experiencing, right? In an average family of, let's say, a couple with children, what we have observed is most likely they will leave behind a real estate, either be it a condo or HDB. Now in this example here, I'm using HDB. Now HDB may worth about 700,000. And then the second item here is combined joint savings between husband and wife would be, you have about maybe 300,000 cash. And I'm sure that a lot of couple out there, especially young couple, they were bought certain insurance policies covering their life, and add it up, it could be, let's say, a combine of 800,000 and some CPF savings here, right? So add it up, you're looking at $2 million for a couple in the case where if both husband and wife are to live together, live this world together, and most likely you would have left with at least $2 million for the family. And this is what we have been observing in a lot of estates that and trusts that we are administering. This is the average value that we have. So with this in mind, so to you must change then your mindset is that you may not need a lot of cash to set up trust, because what we are aiming is, what if when upon your passing, what is it that you have left behind? It could be worth a lot. And in this example here is at least $2 million, right? So another example that I always see is, in this particular case here is a case that I have experienced myself. I have helped to administer. So what we have here is a father passes away and leaving behind 2 teenage children, very young, in their early teenage. And now, if you understand how what this father has done is that he has written a will. That's a good start, okay? But in that will, he has mentioned in a very brief manner that all his estate are to be given to his 2 children and the spouse, right? So, and what he has done also is to make a nomination for his CPF or his insurance that the children are to receive it. If you have understood by now how it works is that for insurance nomination, for a person who is being nominated, i.e. the nominee, they will receive it at the age of 18, not 21. So meaning that for this particular case that I am administering, the children will get at least $300,000 each at the age of 18. So the concern here would be, is it too young? Well, here comes the next point. Because of the way that he has designed his will, is that the assets are to be given to the children. He did not specify at what age. So by default, the inheritance age would be 21. So the children would inherit the assets at the age of 21. And then here comes the next point. The mother, meaning the spouse, who is still alive, now is worried because she's worried that the children is getting too much at such an age. So here comes the question. A lot of us thinking that by writing a will itself is sufficient and making certain nomination to the beneficiaries is the only solution, right? But actually that may not be the case. And also a lot of us think that when it comes to estate planning, it's something very personal, that something that you want to do it by yourself. The example here is that the spouse, the father, the husband here has surprised the spouse by making such arrangement because they did not discuss what to do in the case where he has passed on. So the spouse, the surviving spouse here being left behind, now has to worry about how to educate the children so that they won't be wasting the assets away that is being left behind by the father. So what am I trying to advocate here is that when it comes to estate planning, please involve your spouse, right? If you have a spouse, please involve your spouse and discuss what are your common intention. Try not to surprise your spouse. In this case here, the spouse is really surprised, and I'm sure some of you could be asking by now that, is there anything that the trustee like us can do? Well, the answer is no, because if the instructions in the will is pretty clear, is to actually give it away, then as the trustee and executor, the only thing we can do is to follow the instructions. Unless otherwise stated, let's say there's, the trust is being created to hold these assets and to disperse only at a certain age. So here comes my second point, right? So a trust, therefore, can be set up to, say, allocate certain condition in order for the person to inherit. And in this case here, we can stipulate an age. For example, we can say that instead of 21, we can set it to 25, 26, 30. Now, from my experience, on the average range would be between 25 to 35, or in this case here, I've written that to be 28. Why 25, why 28? Some people ask is because, well, if you look at how we finish our education, especially at first degree, we should be somewhere around the age of 22 or 23 if you're a female. If you're a male, by the time you finish your NS and then you have finished your degree, maybe 23 to 24, and you started working at the age of 24, let's say, right? So that would then bring you to the society and you would start to learn about the value of money. And that is one of the main concepts about trust and preserving your legacy, is to actually educate your beneficiaries, especially minor children, about the value of money. Now that is just one thing. Age is a classic scenario of how people would set up the trust and to hold it. Now the other point would be life events. What kind of life events that I'm referring to? It could be, let's say, in addition to just attaining 25, you must work for the next 3 years, full-time employment, in order to receive the, let's say, your entitlement. Meaning by the time that you receive it, you should be at least 25, and you have worked for full-time for 3 years. And you could not achieve this kind of life events or achievements, then maybe I would delay the gift, or actually to cancel the entire gift. All right. So other life events that are quite classical would be marriage. So some parents believe that if my children are to get married, then they'll be more mature because they have their own family to take care now. Or other life events could be as simple as just obtaining the first university level degree. So these are some of these very classic examples where parents would think that by the time that my children achieve this kind of events in life, they would be mature enough to take care of themselves and hence to understand the value of money. Now, the other type of preserving your legacy is actually putting some enhancement. So some clients come to me and ask, well, my children are adult now, okay, and I don't have to worry about their upbringing anymore. I don't have to worry about they surviving by themselves. Okay, so what can I do? I do have a bit of savings. I do have a bit of estate left behind if I were to pass away today. And what can I do? Well, some of the things that the clients would agree is actually to set up something that we call as a family values and objectives. So it could be as simple as just setting up a trust fund for education, meaning that instead of just benefiting your children, what some parents or grandparents have done is to say that I have allocated a fund, let's say $1 million or $2 million, that is to allow my grandchildren to tap into this fund by the time they have attained certain age or when they are pursuing, let's say, their first degree. So the idea here is that you're advocating the family to pursue for education, and you are telling them that there's always a fund left behind for you. Okay? The other points would be entrepreneurship fund, meaning that some business parents who are running business, they felt that there's a need to, in advance to education, they want to tell and give the children or the descendants an opportunity to start their own business. Hence, what they'll do is they'll set up certain conditions. Let's say they'll set up a committee where they will say the family members, the descendants, grandchild, whoever it is, can come to this committee and bring up a business solution. And with that business solution, then the committee can then decide whether or not to advance certain funds to this person, either be it as an interest-free business loan, or it could be just as simple as a gift. I give you $100,000, you can start off with this business, and the balance, if you need more, then it will be in the form of business loan or interest-free loan. Okay? Now, achievement awards is something quite similar to what I've mentioned earlier, so I won't repeat that. The fourth point, interestingly, is about festive celebration. I got this idea from clients, not myself, right? I don't creatively write all this, so I actually combine some interesting intention throughout the years. Now, some parents or grandparents believe that to maintain family harmony, it is important to stick to certain family tradition. Now, this family tradition could be as simple as just having a reunion dinner every year during Chinese New Year, okay? Or attending, let's say, Qingbing, right? Cleaning up the graves, all these. So what they'll do is that they'll allocate certain funds that to say whoever that attends such dinner event will be given certain amount of money. Okay? And it may not be much, but it will be sufficient, let's say, to cover your transportation. If you are living overseas, transportation is free. For you to attend this event alone, it will give you a certain ang pao. Okay? Well, the main point is not to give you the money. The main point is to tell you that please come back and have dinner and to understand what is going on in your family so that the family doesn't go adrift too far apart and without having to know each other, right? So this is some of the events that the client has set. Now, the second point here would be asset protection. What is important here is to, if you can see from this picture here is, well, you're around, if you are the main and sole breadwinner or you're the main caregiver for your family, when you're around to protect them. Okay, so what we have seen in the news, right, is that when you as the main caregiver of the family are no longer around, then you have an issue of predators. Predators that will be looking at the estate that you have left behind. Okay, let's go to like some of this news. Okay, it's a very classical news where the Chinese tour guide news. So this has been gone throughout the news limelight in Singapore, so I will not repeat too much in terms of the facts, but interestingly what we have seen here is in terms of planning for elderly couple. So in this case here, the elderly couple, the husband here passed on, leaving a substantial estate for the wife, and subsequently what happened is the wife is then suffering from a certain degree of dementia, and because of this, she was then being approached by this so-called Yang Yin, Mr. Yang Yin here, who then claimed to be adopted grandson. Now, the main focus here is not on the facts of the case, but it's on what can we do, right? So you may not feel this because you're saying that, well, I'm young, or maybe I'm sure I have children, I don't have to face these kind of issues. Well, the main point here is that when we plan, we have to plan not just for the fact of just upon passing everything left to be left behind for so and so, right? But it's also about having to put in a small layer of protection, ensuring that during the later stage of our life or our loved one's life, they are being taken care of as well. There's some safety net being left behind. So what can be done is that instead of giving everything to the spouse, maybe you want to give substantial assets to the spouse. Substantial here is quite subjective. It can be as simple as just 50%, 40%, giving a house, giving $1 million, that doesn't matter. But what matters most is for you to then reserve an amount. Some reserve, let's say, a house, making sure that in case that my spouse is being cheated off, she will have a place to stay. Putting in, let's say, $1 or $2 million in a trust to make sure that in the worst case scenario, she got cheated off at everything, she can still have a bit of savings left behind in the trust that I've set up to make sure that I can pay for the rest of her life. Okay, now this is the main point, right? Asset protection. Now the other type of so-called different perception for asset protection would be, well, what if they are not vulnerable per se, right? So, but in this case, if you look at this, there's no trust being involved, but I would like to see this as an example of leaving behind something to family, and when your family has no idea how to manage monies. Now, in this case here, the tragic case of widow of the killed Changi airport worker. So after the tragic case, the wife has gotten some monies up to $1 million throughout some donation and some insurance payout. And from there, after a year or within a year's time or so, from that $1 million, it was reduced to zero. Now, if you're interested to find out more, you can just Google it now and you see what are the facts behind this case. Again, I'm not focusing on the facts of the case. I'm looking at what can we do, right, in terms of planning. So same thing, if you are the person who is sole breadwinner, okay, and you are the person managing the finance for the family, the idea here is that if you are to leave everything behind to a person, to your spouse, to your children for them to handle, the question is, are they capable enough to handle it? And in this case here, in this example here, obviously not, because from this news alone, we can see that when you have obtained certain wealth, and all of a sudden in your surrounding, you have a lot of entrepreneurs, a lot of investors telling you that there's an investment that will work for you, right, and can grow your money. They may be professional, they may be not, who knows, right? So the point is, can you do something about that? So simple thing, put it in the trust, and you can control how much to be released to the family, so that your spouse, your children don't have to face this kind of issue where, yes, you're left behind with something, but it's gone within 1 or 2 years, they're back to zero, and you're gone. You're not there to take care of them anymore, okay? Now, the third point here would be pooling of resources. Now, interestingly, a lot of clients are saying that, well, what if I don't have minor children, I don't have dependents, my children are all independent, my spouse is even smarter than me, she knows how to handle monies, okay? So what are the things, what are the objectives that people would usually have in order to set up a trust? Well, the third point here would be pooling of resources. Well, it's quite similar to the first point that I've mentioned, but interestingly, if you look at what you have today, you have, let's say, savings in your bank accounts, you have certain property or properties, insurance, you bought some life insurance policies, certain investments, business, CPF, and some of your valuables like your watches, your jewelry, okay, things that you value a lot. there is a lot, meaning a lot may not be in terms of value, a lot in terms of different items. It's scattered everywhere. I have clients who tell me that they have like 5 to 6 different bank accounts, all right? And the savings are all scattered all around. Okay, I'm not sure why they do that. Maybe it's because they're too wealthy that they think that it's better to diversify it, okay? But the fact is, you have now a lot of different classes of assets, and then it comes to this point here. We purposely put it in this way because you will see that, wow, there's so many links here and there, right? Because when it comes to estate planning, some of the things that you must look at is you like to look at the types of assets, because different types of assets would have different types of difficulties to manage. For example, when you have a house, how do you manage that house? Do you rent it out? Do you allow your children to stay inside there? When you have a car, do you sell it, or do you give it to one of your children? Would they quarrel over it? Well, that remains to be seen, right? That's something that you need to think through. And other than that, then you have to think about yourself. Things about how do you distribute? Who should I appoint as the executor and trustee? Where do I keep my will? Who do I appoint as the guardian of my children in case I were to pass away and they're still very young? Okay, so if you look at these 2 slides alone, you have a lot of different types of assets, and then you have a lot of points to think about. So, therefore, you will need a trust that is able to consolidate all the assets. Okay, now it sounds very simple, but actually it's not. In your estate planning, it will involve multiple documents that you see later. So the idea about building up family reserve, in this case here, pooling of resources, is that by pooling your resources, you are able to build up family reserves. So in this case here, you are setting up, let's say in this example, just $1 million. You don't touch it, you leave it there just in case that your descendants need it. How much will be left after 100 years, assuming that you can grow it at the rate of 5% per annum? It will be 131 million. Okay, so from 1 million to 131 million. The second idea, what if you have a very valuable piece of property? And this example here, this is not under trust. I'm just using these news alone to give you some ideas about the value of real estate, right? So the Longhouse Food Court here was being bought back in 1980 for about 600,000 at a time. So then in 2013, 2014, it was sold for 45 million. Okay, and that is a 66-fold increase in 33 years. So you can imagine that if you have a valuable piece of real estate, and if you can just pool it together in your trust, put it as a reserve, well, that would serve as a capital gains throughout the years, and you would benefit more, not just your children, but your grandchildren and your great-grandchildren, right? So what am I advocating here? Of course, I'm looking at a trust, but you're looking at a trust that can serve all families, regardless of their situation, regardless of their objectives, and is flexible enough to cater for all these needs, right? You need a trust that is cost-effective. So what do I mean by cost-effective? Cost-effective does not mean it's cheap. Does not mean that it's free. Okay, but cost-effective in the sense where a lot of time when we set up trust, the idea about trust frightened us because you're thinking that I need to hire a trustee, I have to pay for the setup fee, I have to pay to maintain the trust throughout my life. So does it make sense to have this kind of cost? So hence, when you say cost-effective, you're looking at a trust where once you have set it up, it's either there's very little to no administration fee. And the trust itself must be flexible enough that it can cater to the changes in your life. Let's say when you set up the trust, your children are minor. Okay, maybe they are toddlers running around. And then it must be flexible enough so that in 10, 20 years down the road, as they grow up, you can always go back to the trustee and to request for a review and to change the terms without incurring too much cost. Okay? And of course, most importantly is control. A lot of time when it comes to trust, if you see from the first slides itself, when the trust is being set up, you must ensure that the assets are now being transferred to the trustee. So you will lose then the control over the assets. Hence, it is important that the trust structure here to be flexible enough to allow you to control your assets while you're alive. So what we are looking at is standby trust. Now, the standby trust itself is just a very simple solution. You set it up today, there's very little or no administration fee throughout the years until activation. So when is the next activation point is most likely to be your death and your mental incapacity. And look at this chart, very complicated, but it put in a simple term if you may follow the flow. Let's say Mr. Tan here today is to set up a trust, right? Then, like I mentioned earlier, there are a lot of things to consider. He has to consider for the fact that upon his passing, what happens to his investment, business, property, and cash. Now, that can be easily covered by writing his will, and in his will, he can just write to say, I want to give my parents 10,000, siblings 10,000, and the remaining balance would then be transferred or settled into the trust that I've set up. And this example here would be Mr. Tan's family trust. And he may also want to cover the scenario where, what if I did not die immediately? What if I suffered from a car accident and now I'm mentally incapacitated? Can I then use an LPA to activate the trust? The answer is yes. Right? Through the combined usage of LPA, you can activate the trust and to also able to transfer asset to the trust now to benefit your beneficiaries. And most importantly, because standby trust is flexible enough that it can allow certain assets to be transferred to the trust via nomination. Now, that's one of the whole point of our forum today, right? We're looking at CPF. And CPF actually, your CPF savings can actually be transferred to this trust by way of nomination. Okay, so that will be all for my sharing. Thank you, and I'll be looking at certain Q&A. Okay, RC. Are we able to put in HDB flat as part of the estate planning under trust? The answer is no. The general answer is no. HDB flat cannot be held on trust. That's by way of regulation. Are there laws that prevent abuse in the management of a trust? Well, there are always laws there that says certain fiduciary duty that the trustee must practice. For example, the trustee is responsible to prepare accounts, to track record of the ongoing, outgoing of the trust. But the thing is, in a lot of news that we see, by the time that people has noticed there's a breach of trust, the person is gone. All right, the rogue trustee is gone. So yes, there are certain laws that says that to say what constitute as breach of trust, but who you choose as a trustee is very important, because if the trustee runs away, it's very hard to track it back sometimes. Okay, can myself and spouse set up a common trust for our children? The answer is yes. So the beautiful part about standby trust is that it allows for a joint setup, right? Meaning that your spouse and yourself can actually set up a trust together without having to set up a separate trust. So that will be all. I will answer, there are too many questions here. All right, I have answered 3. But okay, I'm told that I can answer one more, so I'll just select one more. Okay, does a fully paid private property transfer into a trust subjected to pay any taxes? Well, there's no short answer to this, but to put it simple, if you plan it properly, let's say if you write it in your will to say that the property is to be transferred to a trust, then you can actually reduce the payment for your stamp duty to a 0, in fact, because under the current stamp duty regime, if an asset, meaning property, is being transferred or being held in trust, there's no stamp duty payable. All right, that will be all. Thank you.